basically, with debt levels as high as they are, and with Treasury issuance as high as it is, it's pretty challenging for the Fed to normalize interest rates without crashing the markets. And so they kind of find themselves where they can either let interest rates stay low and let these spikes of inflation basically devalue cash and debt to a significant degree, or they can try to raise rates and taper to combat that, but then they risk pulling down asset valuations across the board. And because the market is so financialized, if asset prices have a significant fall and stay there, that actually circles back and results in slower economic growth.
Let's talk about inflation. Obviously, this has jumped onto people's radars in a major way. And maybe just to start, what's your read on how much what we're seeing right now is so-called base effects, how much is transitory versus something that should be, people should be paying more attention to?
Yeah, it's a really good question. And I think, there are a few layers of inflation here, and some of those are more transitory where others are more sticky. And so the base effects are a pretty big figure. Like, for example, we saw roughly a 5% year-over-year CPI print this past month. And, somewhere around 3% of that is, if inflation did nothing abnormal over the past few months, and you just compared it to that May 2020 period, because that was a very low point for inflation, you'd have roughly a 3% year-over-year period, right? So maybe 3% of that is base effects, but that additional 2% was largely, actual inflation. So that's stimulus-driven things, that's supply chain-driven things, all sorts of problems like that. And so as we go into, June still has pretty low base effects, but as you go into July and August, especially, those base effects get harder. And so the year-over-year numbers are likely to be lower than 5%. So 5% could be the peak for this particular, kind of moment in time, at least in year-over-year terms. Now, if you look longer term, the Fed's long-term target is about 2% average inflation, the way they measure it, which is PCE. And right now we're above that. And even if just say inflation indicators stop going up now and they just kind of go flat, we would still be elevated by the end of the year. And so by most metrics, we are running hot in many ways, but the rate of change is likely to cool off a little bit. Now, longer term, there are still multiple factors at play that are probably resulting in a more pro-inflationary environment, but they depend on a couple decision points. So one big one, for example, is whether or not the U.S. continues to do more stimulus, like particularly in the form of infrastructure stimulus, right? So we're past the fast-acting kind of adrenaline stimulus where you just kind of give out checks and stuff. But a big question is whether or not we're going to have these kind of very large structural fiscal deficits, or if we're going to go back to kind of a more baseline, say 5% of GDP deficit, which is still huge in kind of historical context, but it's different than more of a, kind of a multi-trillion-dollar infrastructure bill added on top of that. And so that's kind of a big political question to watch over the next year or so. And then longer term, we're also seeing a risk for potentially energy-driven inflation. And so one of the areas that's still being sticky is higher energy prices. And if you look at kind of if you back up a little bit, ever since 2008, we've basically been in a oil and gas bear market, and especially the past 5 or 6 years. And so we've been in this period of oversupplied oil, and that's because North American shale oil ramped up production faster than global demand kept going up. And so we entered this period of structural oversupply. And basically oil drillers just kept drilling even if they weren't free cash flow positive. Just low interest rates and new technologies came together, and they just, they didn't ask if they should, they asked if they could, and they could. And so they just kind of made a lot more oil. But now, due to just 13 years of really bad returns for the oil sector, and then you had the oil price crash in 2015, then we had the 2020 COVID, and then now you have ESG concerns. So some pools of capital are just not putting into oil stocks at all. Now capex is very, very low in the industry, and so they're not really kind of spending a lot of money to find new reserves or bring reserves up to supply. And so when you look at a few years, as global energy demand continues to grow and recover, especially from emerging markets, at this time where capex is now very, very tight, we actually could see kind of energy shortages in the years ahead, which would be the opposite type of regime that we've been in for the past decade. And so if that were to take place, that would give us another leg up in inflation. And so I think when you take into account wage growth, some degree of reshoring or kind of a flattening out of globalization and potentially slightly, kind of a slight reversal of globalization. And then you include the possibility of energy shortages. I still think as we look out into the 2020s, we're going to see more of these kind of inflationary periods, most likely.
Well, it sounds like, I mean, it sounds like your point of view on it is that a lot of that is sort of structural and based on decisions that were made a while ago, right? We talk a lot about the inflation conversation as it relates to what the latest FOMC meeting said, but I kind of think the point that you're making is that some of this is baked in, and it's more just how it plays out.
Yeah, I mean, basically, when it comes to overall policymaker decisions, we made mistakes decades ago by encouraging debt to get as high as it has, and doing some of the monetary policy we've done. And now the debt is this high, they find themselves with very little choice other than to essentially, financial oppression. So maintain interest rates that are below the inflation rate. And that's obviously easier to do when you have an inflation rate that is above 2%. So they want to hold rates around zero, and they want to have inflation kind of run hot for a little period of time. And of course, policymakers, they want things to be kind of smooth. So they don't want 9% inflation, but they want positive inflation that is above the interest rates if possible. And they don't really have much of a choice. And so my base case for a while is that we're going to, the 2020s will be a period of, certain inflationary spikes without corresponding increases in the interest rate to kind of keep up with that. And so, for example, we've seen if someone bought a 5-year treasury this time last year, all of their interest payments for the next 5 years of that bond are already outpaced by inflation. So unless we encounter a period of outright deflation, in the years ahead, that bond's already underwater. And so we're going to be at the case soon where someone bought a 10-year treasury in 2020, so especially the middle of 2020 when interest rates are like 0.6%. The entire 10 years worth of interest payments will be outpaced as soon as essentially the CPI is 6% higher than it was back then, which is not that far from now. It's only a couple quarters away. And so I think that's going to probably continue for a good chunk of the decade, where cash and bonds are going to be yielding rate levels that are below the prevailing inflation rate. But that inflation rate will have periods of being elevated due to either shortages or fiscal stimulus, and then ahead of periods of kind of returning to normalcy until you have another catalyst, which could be infrastructure spending, could be energy shortages, things like that.